Hey, y'all, welcome back to another Agency Builders webinar series. Super excited about today because the things that we're talking about are the kind of things that make or break businesses of all kinds, but certainly agencies. Maybe it's just me, but a lot of us in the creative world aren't always the best with the numbers. We're good with all kinds of things visually, making things look great, but it turns out it's hard to run a business without cash in the bank. And having cash in the bank requires a lot of things, but certainly having really good forecasting and really understanding cash flow. These are things that messed me up really bad in the early years. And I'm really excited to have Jody with us today from Anders. We've been a longtime friends, and he's worked with agency builders really since the start to help our community learn and grow together. So, Jody, welcome to the show.
Yeah, Jay, thanks for having me.
So,
This is pretty exciting. I'm excited about this because we were talking in the pre-showing, talking about how we're going to kind of do this more of a non-traditional style format. Instead of me just preaching up here and everybody falling asleep outside there, we're going to have more conversationalist, which is going to be something. This would be a lot of fun, I guess.
yeah, I'm excited about it, and so I'll interrupt you along the way. You know, you and I both are pretty good interrupters, if we're being honest, and so it'll be
Yeah,
great.
no
So
problem there.
Jody's got a deck he's going to walk us through. But if you have questions along the way, if you're watching live, I've got the chat open here. Just let us know where you're zooming in from. Well, we're not on Zoom, but you know what I'm saying, close enough. So I'll
Mhm.
just put a little chat over here. And then if y'all will drop a message in the chat, let us know where you're coming in from. If you're watching this in post, which I know a lot of you are on demand, so you can catch it in like 2x speed to optimize your days or whatever. If you have questions along the way there, leave comments below in the community or wherever you happen to be watching it. Our team will come back and either answer those questions or get with Jody and his team and help get those questions answered for you, because a lot of times this stuff can get a little bit confusing. But Jody, we've gone through this deck already. I think it's going to be super helpful for you. And it's going to create a path where you have visualization of your numbers. And if you get the numbers right, my uncle used to say, everything's funny when you're making money. So, Jody, take it away.
Yeah, no worries. A lot of people, think that, hey, when I created this thing that that it came to me, or it was something that just is inherent with a finance person, and I have to kind of laugh about that because my journey was completely different than that. When I started a business, which is a lot of, and as an entrepreneur, a lot of people I think can relate to this, is that I was pretty decent with what I did, and then when I started the business, there I was like, oh my gosh, how do I do everything? What's the perfect way of doing things? And man, I failed a ton when we started, and a lot of it came down to really just not understanding. Even though I understood the numbers, I understood numbers pretty well. I just really didn't understand how they really kind of correlated, and how easy it was for me to go through a lot of the things, but then other people not as easy. And I kind of think through that when I created the service based model, because we initially were just an hourly bill shop, like a lot of folks start out with, because that's really the only thing, right? Hourly bill. And then we moved into a flat fee bill shop, and then that wasn't working really well. And then we worked into a subscription based billing model, which worked out really well for us. And so I'm going to talk a little bit about that as we go through here today. But again, the point I'm trying to say is that we did everything wrong to start off with too. We billed the wrong way, we collected the wrong way. We became the bank for our clients. You hear that saying a lot. We were that person.
Yeah.
We had no money to start with, but we still were the bank, and that was like, oh, geez, how are we going to do this? So payroll was one of those things that, do I have to move my paycheck in order to pay somebody else? You remember those days? It's like, do I take distributions? My wife's like, hey, when are you going to be successful? Like, talk like you're going to be successful, because I'm the super optimist with everything, right? And it's like, oh, we're going to be great next year, honey. And next year would pop up, and it's like something would happen, and then we'd fall backward a little bit, and it just kept going and going and going. And it was about an 8-year cycle. And Jay, I'm kind of curious about you on yours, but mine was like an 8-year cycle before I really started seeing a profitable business that was growing to the likes that growing to something that I could really kind of sink my teeth in and say, hey, things are starting to look good.
Yeah, I mean, for me, I started so young and I really didn't have any business education other than I always talk about my uncle. He was kind of my business mentor and helped a lot. But I mean, I joke about this, but it's not really a joke. I don't think I could have told you the difference between net profit and gross profit for probably a decade. And look, y'all, we didn't have Chat GPT back then. Okay. We had Google sort of, but it was still just kind of in the early years too. So I was just figuring it out as I went. But one of the things you said I think matters a ton, and I don't want people to miss it, is you said we became the bank for clients. I don't think people always think like this, but the reality is, and what you're pushing at there is, if a client is late to pay you 2 weeks, 30 days, 60 days, 90 days, and you don't have any kind of plan with regards to how you're, charging interest or penalties over time, then you're literally just giving them interest-free financing. And then what that means is you've got to figure out how to get that money on the other side so that you can pay yourself, pay your own bills, all those kind of things. And I mean, Lord knows I did that for many years. The advantage I had in the early years was it really was just me, and my computer. So my overhead was super low. So I was pretty profitable pretty quick, even though I barely could explain what that was. But it took me a lot longer to grow. And if I had had some of this knowledge, especially as I started to hit that like $1 million mark, it's like you really get yourself messed up because it turns out more money isn't always better. And so anyway.
And I'm going to definitely talk about that in a little bit because we ran into the same issue, but before we get into the actual model, the forecasting model itself, I really truly want this to be, an answer question out there. So as many chats as we've got here, I'd be happy to, jump in and answer those questions because it's really important that I hit on all the different topics that are important to you all in the agency world here. The big thing here is that, ask early, like I said, nothing's off the table. I'll answer any question that you want, how we do it. Everything has been pressure test. We want to make sure that, hey, when you're going through creating this forecast, creating this dynamic, and make sure it is super dynamic, that, it's something that you truly use going forward, just not, fancy spreadsheets or anything like that, it's not one of those accomplishment goals, hey, I've got this, great, let's go from there. When we create the forecast, the first thing, and I'm kind of doing this in the eyes of a CFO, as if you were my client, walking through things. The first thing that I would want to find out is I want to find out really what your end goal is. Because before we talk about cash or billing models, or the forecast itself, I really need to know what we're building towards. And a lot of agency owners say they want to grow, but growth means different things to different people. The same revenue can be healthy or dangerous depending on really whether I'm building to sell or maybe just building a lifestyle company. Both are perfectly fine. We just need to know which direction that we want to go. So before I argue the forecast, I want to make sure that I understand the destination. Again, are we building a sell, family transition, growth platform? Because each of these, again, are handled completely differently. I think, Jay, you alluded to that just a few minutes ago when we were going through that. But again, the end of mind is the first thing that we want to look at. And so when you're thinking through your business, I want to make sure that, when we go through this, I want you to keep your business in mind the entire time, not really what your dream business is, but, really where you're at today. And then we'll kind of walk you through, hey, here's how we progress, going forward from there.
Just real quick on that one, I'm just curious on the type of business. I think I always thought to myself, I'm not building a business to sell. And I'm still not. I mean, it's not on my radar. I'm building a lifestyle business. I always have. Like I want to have, it's all about family and freedom and flexibility. And I want to make good money too, no question. Yep. However, one of the things that I've kind of like had to adjust to over time is like, just because I don't want to build a business to sell doesn't mean I shouldn't build a business like I'm going to sell it. Because ultimately, what is a business that you're going to sell? It's a profitable business that has good operations, good systems, and isn't totally dependent on you. And it turns out if you have a business like that, you actually probably have a better lifestyle too. So I don't know what you think about that, but that's kind of been a thing that's been churning in my head lately.
No, that's exactly right. Because I was the same way, Jay. When I did it, it was a lifestyle business. I wanted, hey, we're going to work 4 days a week. We're going to have, parties. We're going to do these great vacations as we go to Vegas and all these different areas. And we were going to treat this as a lifestyle business as well. And because we were never going to sell either. Heck, why? I mean, I can do this till I'm 65 years old. 70 years old, 80 years old. What? There's really no end in mind because again, it's just this. Consulting is consulting. And then I pretty much realized pretty quickly, like you're saying, that I really do need to build this as a business that I'm going to sell, even though I'm not going to, because at any point in time, I could get that opportunity, that offer. And if I'm not ready, if my business isn't ready for it, man, I could really lose a great opportunity. And when businesses look, when people approach, they're looking always at a 3-year look back. They're looking to say, hey, what was your last 3 years looking like? And I always wanted to make sure that my last 3 years, I could explain my last 3 years let the numbers explain themselves without me trying to explain those numbers to a prospective buyer. For instance, a great example is, hey, you got 1 year that's really great, 1 year that dipped down, it's not as great. The next year is great again. I want the business owner to be able to look at my financials and understand that path versus me explaining, well, I did this and I did that and I did this and all these different things that I did or didn't do, or maybe I'm blaming the economy. The economy did this, the economy did that. In reality, it all comes back to you. How did you manage that business, and how did you, and forecasting is a big key to this. But the whole thing is, I wanted to make sure my last 3 years looked like my strongest 3 years, so that when I did get that opportunity eventually, again, not looking for it, but when I did get it, I could look back and show that really solid trend going forward, and again, let the numbers talk for themselves.
Yeah, it makes a ton of
So,
sense.
so when we look at things, the first thing that we look at before we actually get into a forecast itself is try to determine what our cash floor is. And cash is not really, it's not a vanity number. It's really how long I get to make decisions. When we went through the pandemic, for a lot of folks that had a ton of cash, they were really able to make really strategic decisions. They were able to sit back, think about things, and they were actually able to make those decisions without simply reacting. Because other folks had to react. They reacted, and maybe they reacted well, maybe they reacted bad. You can kind of see exactly the situation, because when you're in a situation where you have no cash, you got to make decisions super quick. You have more cash, you got a little bit more time. So cash buys a lot of time. And so the key here is I wanted to figure out, what is that cash floor? What is that dollar amount that's going to make me happy so that I can sit back and make decisions if I lose a giant client? If something really bad happens to my business, or something happens to the economy, that I really got to kind of sit back and look. And so the cash floor is the first thing that we're going to touch base on here. And in looking at that cash floor, um, you have to kind of really kind of focus and kind of look and see, hey, where is it at? And so I've got some basic rules here that I like to focus on. We have typically 3 different accounts that we like to set up in a cash position. One of those accounts is an operating account. When we talk about operating account, that's really what you got in the bank. That's going to be your money going through. Basically, about 2 payrolls is what we want in that bank account at all times. And so that's going to be the safety net. That's going to be just your daily operations. But overall, we want to have about 10 to 30% of cash in the bank. And so when I say that, 10 to 30%, those are big numbers. And for a lot of people, those are numbers we don't currently have. But 10% in the bank, when you think about how much your revenue is, that's the amount that you really just need to go on in normal, not really kind of feel a ton of pressure. Maybe a little pressure, but not a ton of pressure with the day-to-day activities. 30% is about 6 months of cash in the bank. So 10% is about 2 months. 30% is about 6 months. And so, as Dave Ramsey would say, you want about 6 months of 6 months of a cash reserve. And that's really goes the same thing with the business. We want about 10 to 30% of your revenue in the bank. And then the third one is that 40%. 40% your net 40% of your net income should be in the bank, going towards what we call a tax reserve account, which is again also super important, because again, it's money that it belongs to somebody else. It belongs to the government. And so we're just holding on to it until April 15th comes around, and then we pay it. And so again, it's important to have and accumulate that money in the bank and then pay it out for the quarterly payments. If you're an S corporation or partnership or some sort of pass-through unit, you've got to make your quarterly estimated payments. So you're building that cash, that 40%, and then you're paying it out quarterly and building it up and paying out quarterly. And so it's just a repeating cycle. But I think it's super important to have that money in the bank and not pay that out personally. And the reason why I say that is because when you're a solopreneur, and you're the only person in there, again, it doesn't make as much of a difference. But your partner, who is on the other side of the equation there, is not too excited when you have to pull money out of your bank account and put it back into the business for some reason. And so that's
Yeah, and
why I say it's important to put that in there.
I would even say like when you're smaller, it's helpful. It's helpful for me, over time to kind of have this bifurcation of where my money is, to know
Mhm.
this is money that I can spend in my personal account on whatever our family chooses to spend it on. This is money that I
Mhm.
cannot spend. It exists out here, but I'm going to have to pay it out some point in the future. And I'll just tell a quick story like that got me in trouble, or could have gotten me in trouble, was I didn't have good cash reserves going into COVID. The timing was bad. I did not have good cash reserves. And for better or worse, that whole payroll protection program was a real lifeline for us. But it was also like an awareness of what would I have done if this hadn't come through. And that's not good. And so we've now followed this exact model, which is, multiple payrolls in an operating account, at least bare minimum 10% of revenue. And some of the guidance you've given at agency builders over time, like I remember
Mhm.
listening to it the first time being like, ugh, we need to do that. And so now we have it. And so I know if catastrophe hits or opportunity presents itself, because I think about
Mhm.
this the same way. It's like, back in 2009 or 8, whenever it was, when the market economy collapsed, right down the street from where my office is, there's these great like residential commercial condo units that were so ridiculously cheap. I didn't have enough cash at the time to buy them. Well, now they're 6 to 7x what they were then.
Yep.
I mean, that's an incredible opportunity. And so cash not only protects your downside when things are going bad, but it also gives you opportunity on the upside. And you don't want to wait until you need it to have it. And it just requires the one thing that I often don't have, which is discipline to go, hey, no, this money belongs in this account, can't touch it until XYZ. So really helpful.
Yeah, and you really hit it on the point. When somebody comes and asks a question, it could be as simple as, hey, you're the finance guy. I'm the finance guy, so I should have the answer here, right? And so that you come to me and you say, hey, I've got this great opportunity here. In your case, it was building, some buildings to buy. Maybe this is a marketing person or sales and marketing person that you've always wanted to have. That person's come on the market, and they're like, oh, can I afford to have this person on the team? The first thing I look at is cash. If you've got 5%, 4%, 3% of your revenue in cash, I'm going to say no. It's just too risky. You can't do it. That it's just not a good timing for you. And then you're like, oh, that's a bummer. And then the exact same shop right next door, same revenue size, that person's got maybe 15% of their revenue in cash. And by the way, our average client has about 12 to 13%. So it kind of gives you that ballpark idea. With that, I'm going to say, yeah, let's take that. If it's worth it, let's take that risk. Because we can really, we can always let that person go if it's not working out. That's always a possibility, but it's not going to really put us in a dangerous situation, because that's what we're talking about. We're talking about managing risk. Just like Jay had mentioned there. So with that, just the quick math, and this is mathing it out for you. If you're a $3.5 million firm, you should have between 350,000 to what, $1 million in the bank. When we were a $10 million firm, we always had at least $1 million sitting in that bank account, at least. And that was kind of funny, because when we actually went through the merger and got bought out 4 years ago, the first thing they're like, hey, why do you have so much money in the bank? It's like, because I don't want to use somebody else. I don't want to be the bank for. I want to be the bank. I want my reserves to be my own bank. I don't want to be paying interest for a line of credit if somebody pays slow or whatever. And that was really just a key factor there. So you want to have that money in the bank sitting there. Again, the tax reserve, the same thing. 10%, 40%. In this case, this fictitious company's got a bottom line of $650,000. They'd have roughly $260,000, not in the bank at one time, but that's what's being accumulated over time and paid out quarterly. Make a lot of sense?
Yeah, so it really would be, I mean, roughly at that point, they're looking at $65,000 a quarter, essentially. So it's kind of a
Yeah,
rolling number, I would assume, over time.
that's exactly right. And we put that money in the bank every single month. So that money just goes to the bank every single month, gets paid out quarterly. And that's how we
Yeah,
do
and the
that.
big
But we'll
thing here
always
too,
let you.
like, I mean, Yeah, the big thing that's really helpful to me, I read this book, I think it was called Automatic Millionaire or something like that, years ago. And the idea is really simple, like a lot of books, which is just make it automatic. In other words, every time, it's the same thing for me personally, but also in the business. When I get paid, a percentage of that immediately goes to savings, a percentage immediately goes to giving, a percentage immediately goes to an investment account. Same thing in the business. In the
Mhm.
same way that we pay payroll, every single payroll period, a percentage also immediately goes into our cash reserve, a percentage immediately goes into our tax reserve, and I don't have to think about it. Nobody's deciding to do that. It just automatically happens. And I'll tell you what, like, I mean, most of y'all know this out there, but maybe you're like me years ago and you just aren't doing it. But automatic savings, and for that matter, if you're somebody who really wants to have a giving, mentality in your life too, automatic giving. I used to be kind of like opposed to having automatic giving set up at my church, for example, because like, I feel like I need to like show up and like, give a thing. But when I looked at it over time, the reality was I gave more when it was set to be automatic. And it turns out I save more when it's set to be automatic as well, because I don't have to make that decision and then be like, oh, you know what? We forgot to make that deposit last month. Now we're 2 months behind. So now instead of putting 20 grand in there, I need to put 40 grand in there. And it's like, I don't even have that in the operating because I spent it on X, Y, and Z thinking we had the money. Anyway, I say these things because I've done them all, made all these mistakes over the years.
Jay, so I've done the exact same thing. I know exactly where you're coming from on that. It's hard to give when you don't have the money to give. That's where it comes down to. And you can have a great heart and think, hey, I'm going to do that. Just do it. Just have it automatically come out and work on the rest. And there's a lot of great books out there that talk about that exact same thing. And it truly is. It's important. Another thing that's important, I would say, is that to know, hey, when we talk about your accounts receivable, on the balance sheet, everybody knows what their accounts receivable is, right? At least I hope so, because that's something you're looking at all the time, wondering when people are going to, make those payments. And an important factor here is you want to know this simple number, really how many days is your cash gap. And so if you take your accounts receivable days, and you can usually, if you have QuickBooks will tell you exactly what that is. And then you subtract out your accounts payable days, how fast you pay your vendors. So how long it takes to get your money collected minus how long it takes to pay your vendors. That's your cash gap. That's the 40 days that you are actually, that you're actually, that's in hostage for you at the bank, and that you're actually funding for other folks. And so it's important to understand what that cash gap is and to look at that on a regular basis. Is the cash gap getting bigger, or is it getting smaller? Is it staying flat? Because the importance of that cash gap, when you look at it, to kind of figure out exactly the importance of it here, if you take your annualized revenue and you divide that by the number of days in the year, you're looking at 365. So this is kind of easy math here. So in this case, in this example, you're looking at about $9,500 in revenue, daily revenue. If you take that and you say, hey, I want that cash gap to get smaller. I want that the cash gap to get closer to 30 instead of the 40 that we had in the example there. What would that mean in additional cash in the bank? Well, if you take that times 15 days faster, $9,500 times 15 days, you're looking at $144,000 sitting in your bank account. If you wanted to get it 30 days faster, you're looking at 287 sitting in your bank account. This is real money. 144,000, 287,000. For me, that was that difference between making a payroll or feeling confident about a payroll to, and payroll was my biggest thing. My biggest worry period was payroll. It wasn't me. It wasn't my payroll. It was my team's payroll. The folks that I hired that trusted in me. I wanted to make sure that they got paid, and they got paid timely every single time. And a lot of times it came down to this cash gap. My initial cash gap was huge, and because I billed hourly, I was in the hourly trap where I was, with clients. Can you imagine being an advisor, a CFO, Jay? I go into your meeting and I see your cash position. I know that, man, you're really struggling, and I see my bill coming up. That kind of puts me in an awkward situation, right? It's like, hey, oh, by the way, I know you can't pay your payroll, but hey, my bill needs paid tomorrow.
Right.
That was
Right.
that was a tough situation, and so it was one of those things I had to figure things out. I had to really kind of figure out how to really do what I'm doing well, but also, figure it out for the client. And so this cash gap is a real thing and real money here. And so make sure that you understand what that dollar amount is for your business. Super easy. Just take your total revenue, divide by 365, and that's your day, your per day. Go back to your cash gap, and that's how much money you've got in your accounts receivable, basically. And that's how much money that you can save if you reduce that gap.
Yeah, it's super helpful.
So here's one thing that we did when I worked in the corporate world, because I worked in public accounting for about a couple years. I actually got fired from my last public accounting job and said I'd never be successful in public accounting, which was kind of funny. and and ironically, about 25 years later, that same company came back and wanted to buy me. So it was kind of a funny thing. But when I went to the corporate world, the first thing I did, I managed cash. So I was the cash manager for a $250 million company, and with that, we did some basic stuff. It was just simply we took it was a big time spreadsheet, and that spreadsheet broke out a daily cash flow. And so it was, hey, here's the beginning cash. Here's all our expected incomes. Nothing to do with our balance sheet or income statement or anything like that. But hey, what were we expecting to collect today? And then what we're expecting to pay out. That could be loan payments. That could be really whatever, all the different kinds of expenses. And then here's my ending cash for the day. And then ending cash became the beginning cash, and then it repeated day after day after day. We did that on a daily basis at a $250 million company. And so you think about it there, I took that concept, and that was the very first thing I introduced when we introduced this virtual CFO service concept, because we created it 25 years ago as a new concept. And I thought, hey, this would be kind of interesting if I could show a business owner how cash, basically spread the cash out. Now, everybody should be doing this, and this should be an old concept. At least I hope it is. But if it's not, you definitely need to have this understood very clearly. And so I would look at cash at least on a weekly basis. When I was a small business, making my cash is super tight, and even as a larger business, I was looking at it, but more so on a monthly basis, or maybe even every other week basis. It became one of those things that was just a consistent thing. Hey, we're always looking at cash, but the consistency of looking at cash is the really important thing. Not when you don't have cash. Not when that big bill was paid and you're thinking, oh my gosh, that bill shouldn't have been paid. I've got payroll here. I've got to pay that bill after payroll because I was expecting this giant, the invoice to come in later, or whatever the timing issues were there. This is a very important concept on having to understand. I assume everybody has this, but if you don't, the short-term cash is really important. Looking over the next 13 weeks, extremely important.
And I always say
And
too,
so,
like the way that I think about it's helpful for me is I always say it's like juggling money. So, I've got at least three big buckets, if you will, pipeline of sales that I think I'm going to close, accounts receivables, money that I've been, that I should collect, but I haven't actually collected yet, and then cash. And I always say, like, it's just like juggling, and that when you juggle, all three of those balls have to keep moving at the same time. You can't just work on one and not the other. And so, in the same way that, like, I need to know how much cash I have, I also need to know what the receivables looks like, I also need to know what my pipeline looks like. And if you keep all those three things moving at all times, but you just got to know what those numbers are.
yeah, because I'll back up a slide there, because again, kind of reemphasizing this, when you look at that and you got all the three different areas, you're juggling your balls there. Again, you're always looking at, hey, what is my cash floor? And so the cash floor in this case, let's say my cash floor is I would have $100,000 in the bank at all times. That was my comfort feeling. That was maybe as my 4 month 4 month cash burn. And so I'm looking at that, and then as I'm doing this calculation every single week, is it hitting my cash floor? Is it even close to my cash floor? Is it exceeding my cash floor? Because at that point, then that's when decisions can be made, and so and made in advance, because we're extending this out to about 13 weeks, which is about a quarter. So we're extending out to the next quarter, and we're saying, hey, at any point in this time, am I going to be close to that cash floor? And so then you can make decisions now versus waiting until it actually does happen. And then you're like, okay, now what do I do? Because when that happens, those decisions are really never good. And
Yeah,
we're going through it.
real quick, I just noticed Scott had a question in the chat about.
Yeah.
I'll put it on the screen here. He said to clarify, these amounts would all be additive. So 2x payroll, 10 to 30% working capital, and 40% projected. I'm not sure what the NI. I think that's a typo.
Net income
for taxes.
Yeah, probably net income. Yeah.
Yeah, net income.
So
Okay.
basically what that would be is that I would want 10 to 30% of overall cash in the bank. Two payrolls of that, two payrolls should be in my operating account. So you don't need two payrolls and 10 to 30%, 10 to 30% in total, and then two payrolls should be in that operating account. The rest is some sort of money making account, whether that's a high interest savings account, something that's earning money. You don't want it just sitting there. Then the third account is your tax account, and that's the 40% of net income. So that should be completely separate. That also should be in some sort of interest bearing account. Not we use like an Ally Bank account, American Express account, SoFi Bank. There's a lot of banks out there that offer really high yielding interest rates, and that's where I'd stick that other money.
Yeah, we keep all of ours, like the money that we need quick access to, both the payroll, operating cash, and the working capital sits in like I think we have a Betterment account. And I think right now it's like 3.5% interest, which, when there's hundreds of thousands of dollars in there, that adds up over time. It's not nothing.
No, it's definitely not, and it makes money. It makes some money for you. Definitely, but the key though is put it in something that is interest bearing. Don't just let it sit there.
And safe. I mean, it's like, it's not in some kind of an investment account that's going to be way up or down potentially. It's a secure, safe account, consistent interest. But also, we used to have ours in a crappy bank account that had like 0.5% interest or something. And there's plenty of these high interest accounts that are also FDIC insured, also, consistent over time. They don't fluctuate. So if folks aren't doing that, just do that. Like that alone can be a huge thing over time.
Yeah, 100%. And the other thing is that some of these accounts, you have to open up as personal accounts versus a business account. If you open up as a personal account, just make sure that 100% of the business is running through it. Don't mix and mingle your personal stuff with that. And then the IRS will treat that truly as a business account if you ever were to get audited. So that's an important factor to understand there. Don't intermingle your personal stuff. You should never do that anyways. But if you're gonna do that, make sure that it's set up properly there. Okay, so here's where I failed and then eventually succeeded. As we were talking about the hourly bill rate, I'm not gonna say that, hey, one's better than the other. These all three work really well together, and they work really well for different people. For me, it didn't work. The hourly bill rate didn't work for me, although that was the industry standard. That's what everybody in the industry did, was hourly bill. 25 years ago, there is no such thing as flat fee billing or subscription billing at that point. Everybody billed by the hour. But again, with my situation, I couldn't afford to be the bank anymore. And I was providing a service that it was really tough for me because, again, I'm in a conversation, you're struggling with cash. How do I then present my bill and walk out feeling good about myself and good about, and you feeling comfortable about paying it. And so the hourly bill wasn't the key for us. We had to figure a different way of doing things. And so that kind of morphed our model into a flat fee billing system. And with the flat fee billing system, that was kind of good because now I didn't have to justify prices anymore, right? My hours anymore when I'm with a client. But again, if it was done wrong, scope creep can really eat the system to pieces there. And it doesn't really adjust towards, for us, it wasn't adjusting towards, it was pretty much the same for a small business versus a large business. So I had to figure out, hey, if we're going to do a flat fee, how are we going to do that differently? And a lot of people call this like a value-based type of a process. And then we created what we call the subscription-based billing model, and that really worked for us. And with subscription-based, what that allowed us to do is automatically pull the money out on a weekly basis on a billing cycle there, but allowed us to offer services, unlimited type of services. And so when I was talking about that with agency owners, 13, 14, 15 years ago, they, like the accounting industry, said, oh, that would never work for us because all these different reasons. And with that, I would say, try to open your mind up a little bit and how could it work, especially now that AI is becoming more and more a driver of a success. A subscription-based billing model in some way, as if not all of your business, but part of your business, is really going to be the key, I feel, for the agency world going forward. And I'd like to get your opinion on that, Jay, because again, we had so much pushback from far back, long ago meaning 3 years ago, to now it's hey, this might be a way. And I'm wondering, how do you think you could adapt a subscription-based billing model into the agency world?
Well, it's interesting. Years ago, my uncle said to me, he's like, how do you collect money? And I said, well, it's just kind of like I do a project, get paid for a project. So I never really did hourly. It was never my thing, but I would build a website and charge them back then when I was 17, $500, that's what we did. And it was great. And back then that was a lot of money. And then he said, look, you got to find a way to create recurring revenue. So every month you're not starting from zero again. And I was like, all right. So naturally at the time I went into adding hosting on because it's recurring revenue. First hosting account I ever
Yeah.
sold was $10 a month. My cost on it was $4 a month. I made $6 a month on it, times 12. There you go. That was my first recurring revenue. Now we have millions in recurring revenue because we stacked hosting and then maintenance, and now really what we would call marketing partnerships. And I totally agree, especially in this AI world, that the hourly model especially is just not, it doesn't make any sense. Like our value at this point is actually our tech stack. We're almost more like a software company as much as a service company. And so our value in our tech stack of what we've built on the AI side allows us to deliver at a speed and pace that I actually think agencies may end up where the deliverables almost they're not even tracked anymore. Like it used to always be like you get X number of blog posts and X number of design things, and we're going to recreate your website X number of times and whatever, and X number of pages. To some extent, most of that doesn't matter anymore. I mean, we can build a website in an afternoon that used to take 3 months. And so, I think more than ever, having that model where somebody's going, hey, if I were to hire somebody internally, it's going to cost me whatever, depending on the role, 50 to $150,000 a year, plus benefits, plus PTO, plus all the other things. Or I could just hire your agency for, I don't know, 80 grand a year, 100 grand a year, 150 grand a year, whatever it is. And all of a sudden, we can provide almost unlimited service. They're buying a whole team for less than they would pay for one person. And we already have the embedded knowledge, software, AI integration. They don't have to worry about it or think about it. And most people don't want to. So I'm more convinced than ever that the subscription value stack type model is the only way of the future, especially because of AI.
And that's how we looked at it, way back when, a subscription-based billing model. This is great. For me, I'm getting my money on a regular basis. And for a lot of folks, it was monthly, but for us, it was weekly. We went to a weekly subscription model where we zap the account every single Monday, which is great because that's more in line to what an employee relationship versus a vendor relationship. And it was really a great thing for us. So, my AR, my gap that I talked about, my AR gap back there is basically zero. I get my money all in advance before I actually even pay my vendors. And so that's kind of a cool thing. So I reversed it, and a subscription-based billing model will do that. So I don't have a ton of AR trapped out there. I'm not the bank anymore, which is what was a big thing that I had there. But the other thing about it is that I could offer a unlimited type of a service as a CFO. There are certain things I wanted to bucket. I didn't want to offer everything unlimited necessarily. There are certain things I wanted to keep in buckets, like on the accounting side. Hey, are we going to be doing this type of situation, or are we not going to be doing it? Are we going to be doing the bookkeeping, or are we not going to be doing the bookkeeping? Are we doing the tax stuff or not? I didn't want to charge somebody a fee that wasn't going to even pertain to them necessarily. And so I wanted to make sure that certain things I did bifurcate out. But on the CFO side, I wanted to make it unlimited. I didn't want it to nickel and dime somebody on, hey, if we could provide a profit sharing plan versus helping them out with their costing model or whatever that might be. I wanted that to be kind of an all encompassing thing. Exactly what you're talking about, Jay. But we did so on the accounting side. And we got tons of pushback initially from it, from the accounting world. They're like, hey, you can't really do that. You got to charge hourly. You got to show them the bill, all that kind of stuff. And it's like, no, we don't. There's no reason why we have to do that way. Here's how we're going to do it because I feel this is the best way for the client, best way for the customer. And really, I think this is the way the industry is going to go. And ironically, our industry is actually moving towards exactly the way that we envisioned it, 15, 25 years ago. And I see the same thing happening to the marketing industry. It's the same thing. And I really see that you're going to be more partners with the customer versus a vendor. And that's going to be the key there. So let's get into the forecasting here. And so with forecasting, the first thing is we have to identify the calendar. The calendar, and I say the calendar because the calendar really impacts forecasting. How many days do we actually have to bill? If we're billing by the hour, how many hours do we have in the year to bill? How many working days do we have? How many billing weeks do we have? In this case, for this quick example, as you kind of see, every single month has a different amount of working days in it. It has a different number of weeks in it. So it really depends upon which billing cycle as we go through is going to really impact that month's expected revenue. So in this case, the model has 3.5 million. That's the number that we're going to be using throughout this example here of annualized revenue. So looking at the two different areas here we're talking about, we've got the hourly projects and the flat fee projects. Projects work, basically. Then we also have the monthly subscription and the weekly subscription. So I've got project-based stuff, and then I've got reoccurring stuff. And so those are two different types of there's two different ways to forecast each one of these. I'm going to kind of walk through the processes here on each one of these. Okay, this QR code here is a QR code of a booklet that we put together, the forecasting guide. It really breaks out exactly how to do it, and I would highly recommend downloading this. I think you just have to have your email on there, and we'll send you a quick copy of the booklet there. But it really breaks down in more detail than what we're going to be covering today. We just don't have the time today to cover exactly how to do everything. That booklet's going to show you how to do it. Highly recommend it. I wrote it specifically for agencies. But the kind of work into the build here. If you're looking at a monthly revenue model, again, you want to look at the working days. Then you take the working days and you find out what your available hours are on that working day. We just walked through the calendar here just earlier. Then you want to take what we call utilization. So you multiply that by utilization. So utilization is the amount of time that you're actually working on client work. With that, you take that times your billable hours. Billable hours, again, pretty simple. How many hours you have in that project, how many hours you have in there. And then you take that times your average bill rate. So your average bill rate's not what you're quoting, but the average bill rate's what you truly are getting for a client. So like if I'm quoting $200,000 per hour, what am I actually realizing? Is it actually $180 per hour I'm realizing with the write downs, or is it $220 per hour? Are you really doing better than what you expected on your clients there? And so you have to figure out what your average bill rate is, and then that's going to come out to your revenue. So average hours times utilization equals billable hours. Take those billable hours times your average bill rate equals your monthly rate. And so examples down here would be what changes by month. And so in this case, if you look down below there, you're looking at a normal 22 work days in a month. And you're looking at a 75% utilization, average bill rate of 180. You go through the calculation, that month you should generate about $295,000 for that month. In a short month, maybe it's a November, December, where you've got a shorter month, maybe you should be generating about $268,000 in that case. And then in a holiday month, maybe 241. And so you want to go through every single month, even if you're a small, I would say under $1 million client, you want to actually go through this and figure out, hey, what are we expecting each of these different months, and what's available to actually bill out for each of these different months. So once you do that and you recognize that, you're going to see that your months, again, on a graphical scale, that they're going to differ dramatically. In this case, this hourly bill rate, as we showed, you're looking at November, December, you should not expect to have the revenue that you would have in maybe the summer months when you've got more opportunity, more time to actually bill. So with an hourly bill project, the big KPIs here would be billable hours. How many hours can we actually bill? The utilization, understand what utilization is, average bill rate, and then your effective bill rates is basically how much are you billing total divided by how many hours you're truly working or earning, and then your AR days. These are I'd say the 5 KPIs, non-financial and financial, that you really need to understand in order to really kind of build that forecast up. Looking at a flat fee project, flat fee, can be great, but it still needs a lot of discipline with it, because a client might not care how many hours it takes to get it done, but you better really care, because that's where it comes through. If I sell a project for $100,000 and need 200,000 or maybe 200 bill, basically $200 effective rate, I've got about 500 hours there. So again, you're doing the math. If you're way over that or way under that, that's where you're going to see some leakage there. So again, flat fee can be it can go really significantly higher or lower based on where you're at. And this is probably what you saw, Jay, when you were going through your models with your flat fee, that every month's a little different depending upon when it closes, and it could drop off significantly once you get through like a big project.
Yeah, and the other thing too is, just to be clear for everybody, when I say we don't bill hourly, I still need to know how long things take, which is becoming a little more complicated with this AI world, but I need to know what my actual internal costs are. Now, we're a little crazy and probably not the most efficient, because I don't track hours until I do. And so what I mean by that is, we'll go through seasons, probably of 12 months, probably 2 of those months we're intensely tracking time. I guess we could just do it all the time, but maybe it's just because I personally find it annoying. That's not a good way to run a business, though. That's just how it is. But at least 2 of those months, whenever I hear people say, hey, we've got too much work to do, we're over capacity. And then I look at the numbers and I go, well, that can't be true based on these revenue numbers. Then I'm like, well, let's track time for two different reasons. One, I want to know how long is it actually taking the teams to deliver on these things? And are we actually bleeding out for particular clients and just aren't fully aware of it? So maybe a client, you could have, I mean, y'all know this, you could have two different clients that both pay you, $5,000 a month for some kind of a retainer, but one of them should be getting billed $10,000 a month because of the amount of effort that it actually takes. And the other one, you hardly even, need to do much for. So all these things aren't equal. That's the hard part, I think, about what we do is we're not selling widgets. It'd be a lot easier to sell widgets because it's the same every single time. And we're in the people business ultimately. And so those things have mattered a ton for me as I figured this stuff out.
Yeah, and Jay, you hit on a good point. We've never billed by the hour outside of the first 2 years in business, and so we 25 years. The first 2 years we billed by the hour. Outside of that, we didn't. But we always track time. So unlike you, where we occasionally did it, which I could see that being a great way of doing it if you don't want to do it and you just want to kind of spot check yourself. We had to do it on a regular basis, and the reason why is we were trying to build this concept. We were trying to build hey, if we're going to provide a cash flow meeting for a client, for instance, we need to know exactly how much time it really took to do that. Because if I'm going to price it out at X, I need to make sure that, hey, that's super profitable. And what I didn't want to do is I didn't want to grow real quick, bring on 10 new clients. I'm pricing something out at a loss and not even realizing it because I'm thinking it's going to take an hour, because it would take me an hour to do it, but it takes the team maybe 2 hours to do it because they're just not up, they don't have the experience that I've got at that point, and we're losing money every single time. I want to make sure that hey, we're there, but on a pricing side. But the other thing was, it was on a teaching side for me a lot of times too, because what I found out is that 80% of what we do is process driven. We're super process driven. Everything is pretty similar on 80%. And then 20% of what we do is very snowflakey. There's a lot of variables that go into it. So when we provide a service level, it's going to be different for everybody on that 20% level. What I was finding out is some of my CFOs were snowflaking 80% and processing 20%, and I didn't know it. How would I know it? We're completely virtual. How would I know exactly what they're doing? Outside of what we told them they needed to do. And we found that out through tracking time, because we found out that, hey, every time that, Bob was on the account, we lost money. What's going on here? And especially if that's a recurring revenue model where it's, happening all the time. It's like, wow, we got two similar clients. It's not the client. They're providing the same level of service. Can't be the service. So it has to be maybe the person. And so in looking at the person, we found out, hey, they just weren't comfortable using the software, and they were going back to Excel, using a lot of Excel stuff is breaking down, hard to teach. And it was a teaching moment for us because it really kind of helped us identify issues within our own process and help really teach people and bring them up as well. And so not just leaving them out there, because again, with the way that we do things, if Bob is working on 20 clients and not using our processes, Bob's going to get burnt out quickly, because our processes are designed so Bob can work on 20 clients and have a ton of free time to do other things. And so that really, really important concept to understand.
Yeah, and this is the complex thing right now. We're running out of time because I'm chatting so much, but this is the complex thing right now, which is all those processes that we've had for years are now have to change so drastically because of AI. And people are like, well, I don't have to change them. They do have to change. And if you don't change them, it's going to be the equivalent of like, accountants used to do accounting on paper ledgers, and look, my wife's 82-year-old mom still does that at her little antique store. She's comfortable with it. Good for her. It works out fine. But the reality is, for most of us, we got to get ahead of it. And it's wild too, because all of a sudden myself and then Chris, who runs my agency, he's been here 16 years, we're actually doing a lot more direct client work because we can go direct from strategy to outcome, because we're also really good with the AI, but we also have decades of experience of doing the actual work. And so it's a little wild west out there, but that's my favorite time. So I'm into
it. So when we talk about the hours and flat fee and stuff like that, with subscription based, what we found out is the KPIs are a little bit different, because what we're doing is now, instead of tracking and basing everything on hours, so we use hours for capacity. So we're trying to figure out capacity and when to hire, when to fire people, when to bring on new clients, all that kind of stuff. But when we're forecasting, we're looking at what's the average size of the client we're bringing in, how often, what's the frequency of clients, how many clients do we expect to bring in this month versus next month, and then also what's the churn, what clients are we looking to drop off? Because on a subscription based billing model, you're going to pick up clients, and then you're going to lose clients. You're going to pick up clients, you're going to lose clients as you go through that whole thing. The idea is that you don't want to lose in any kind of subscription base. You don't want to lose more than probably 6 to 8% of your clients. You want to have about 92% retention rate with a lot of with your client base there. And then the speed of pickup and the average client size is really going to be the difference here. And so in this case, you can kind of look at this this example here on a subscription base. On the months that we have 5 weeks in a month, you're going to see an increase in the subscription base. And this is assuming that you have flat, not picking up any clients here in this example here. But you can kind of see in this client, and you're not losing any clients in this example as well. But you can kind of see each month is going to be something a little different. And so that's important to understand, so that when you're forecasting and you're looking at the month of May and you hit $200,000 or hit $300,000, you're like, oh shoot, that's not a great month. Even though it's a little bit higher, we should have had a lot more because we had an extra week in there. And so you're looking at the subscription just a little bit differently on a month-to-month basis as you would on an hourly rate, or even a flat fee or monthly flat where it's just flat across. So again, we're looking at MRR, active clients, churn, expansion, capacity coverage. On a weekly, it's WRR instead of MRR. And this, you'll have the deck here too, so feel free to go through and read through the deck. I'd be happy to walk you through that. But once you determine your revenue side, it's really simple. You just have to look at your cost side. And when you do a forecast, you want to look at your cost side on a month-to-month basis when the actual events hit, not just simply spreading things over 12 months. If you're going to a big conference in May, make sure you slide all that, all the expenses in your forecast that's going to happen in May, so you can truly get what your true picture is going to be for May when you're looking at numbers there. What are we seeing here? Typically on an agency, you want about, you got these different buckets: cost of sales buckets, overhead bucket, and profit. Your overhead is broken up into three sub buckets: marketing, admin, and facility. And so those are the three buckets there. A percentage to look for. You want your cost of sales, or you want your direct team cost with all the burden, to be no more than 50% of your revenue. And so that's a number that is really the key to driving your bottom line. It's not your administration, your marketing, or facility costs. It's that right there. If you're going to not hit your bottom line goals, it's going to be right in the top there. Are you managing your people effectively? And so 50% is kind of like the gold standard. You hit 50%, you're going to have a 15 to 20, 25% bottom line. Overhead itself should comprise about 30 to 35% of your net income. And with that, again, I'd say heavily into the marketing and admin, very, very, very small in the facility costs, especially nowadays with a lot of remote offices, everything. We're seeing that getting a lot smaller. And right now, we are seeing operating profit under 10% in the agency world. What we're seeing with our client base, the goal is 15 to 20%. That's what you're striving towards. We are seeing that the clients that are adopting AI have a little bit higher net income, and the ones that are struggling to adopt are lower. And I don't mean they're selling AI. I mean they're adopting to the use of AI to get their processes a little bit more fine-tuned.
Yeah, this has been a big deal for us. I mean, I think that one of the biggest problems in agency world is the comparison game, and we're often comparing the wrong numbers, certainly for the future. And the wrong numbers to compare are revenue and headcount. And it's like, really, we're in a world where headcount optimization is actually more interesting than it is anything else. And that sounds like that's a horrible way to say it. But at the end of the day, I want highly performing team members, and I would rather run a small agency that's really highly performing than have tons of extra people, mainly because the risk into the future is just exponentially higher. And I've had years where I'm like, oh yeah, more revenue than ever, and profits down again. Like, what are we doing? Like, let's not scale loss, let's scale wins. And so this was us last year. I kind of took my hand off the wheel a bit, and we just had a lot going on, and profit net was not good, dangerously not good. Still profitable, but not barely. But we just got back in there, and did the hard work of going, what are we doing? What are we spending money on? We don't need to spend money on. And I always tell people, it's like, you need two kind of people in a business, in an agency of any business. The entrepreneur, who my instinct is always, well, let's just go get more money. And the manager, whose instinct is, well, let's cut costs. The beauty of cutting costs, though, I remind you all that are entrepreneurs like me, is when you cut $1, you save $1. When you earn $1, you don't earn a dollar. You earn like, I don't know, 50 cent, 30 cent, 20 cent, 10 cent. Like, and so
Mhm.
it's just a good thing to keep in mind. But when you do both at the same time, now all of a sudden we're seeing our best margins ever this year. And our team's benefiting because our team has a profit share that's quarterly as well.
Mhm. Yeah, we have the same mindset with ours. We're seeing our average client about $250,000 per producer. So
Mm-hmm.
that's what the average there. I think it's like
But that used to
180
be
or
a
100.
unicorn number. Like, I mean,
Yeah, it used to be
15
completely
years
different.
ago, that's a unicorn number.
100%. Yeah, that was like, hey, could I potentially do it? And
Right.
even with our business, we when we did the merger, we were, and again, we're very similar. So when I say our business, an agency is very similar to an accounting firm. Same metrics, same model, same experiences. We had about 55 people in the merger, and we did 10 million. We'll do 17 million this year with 60 people. So we
Yeah.
added five people and another 17 or $7 million in revenue. And
That's
the
crazy.
idea is that, hey, utilizing AI, utilizing processes, really fine tuning things, and that's the number that you want to see if you can get to be as high as you can possibly get. And that versus people versus revenue. Like you said, the revenue per head count is really the key driver there.
Yeah, Kevin had a question in the chat. He says,
Yeah.
on subscription model services, how are you juggling or judging profitability since the deliverables might change drastically from one month to another? I've had a hard time uh, thinking like this month might be a light month, the next month might be
Mhm.
a heavy month. What structure are you
Yep.
using to judge profitability?
Yeah, so we look at profitability, and for us, it would be very similar to you. You want to have about a 72 to 75% what we call contribution margin per client. So what that means is that I want to have 25% of my cost in the client, and then the rest should be profit. And that profit then will eventually weed down to 50% overall company gross profit, and it just kind of funnels down there. And so the big thing with subscription base is that on some months you're going to have 50%. Other months you're going to have 90%. And you've got to be able to understand and accept that as, hey, I'm cool with that. And a lot of people aren't cool with that. They want to get the exact dollar amount per thing, and you're not going to find that to be true in a subscription base. So your goal is not necessarily client by client, project by project, having that same margin. Your goal is, hey, over a period of time, I've got to have that margin. So when I look at when I look at my client base, I look at it and say, okay, where is my overall margin? Oh, my overall margin 70%. I need to be at 72%. Then I dig deeper into it and I figure out, hey, these are the 10 clients that I'm working on. Why is client XYZ at 50%? Okay, so then we dive into that and say, hey, is it just because they're, they got a big project going on? We're spending more time there. Is that a reoccurring issue? What is the reason why that client is at a low margin there? Are we out of scope? Because I define my scope with my subscription base. Are we out of scope there? And do I need to then go back and redo scope? What's the reason there? Or, the reason could just simply be, hey, we're putting more time into it, and that's fine, knowing that, hey, that's not going to be a reoccurring thing. And then I continue looking at that client over a period of time, and over 12 months, I should be at that 72 to 75% contribution margin. If not, then I've got to then either figure out, hey, is it a pricing issue or is it a people issue? And then kind of work into that model. So again, you're managing things you're managing your processes now versus just simply billing by the hour and high fiving, when the client hopefully pays you in 45 days.
Yeah, and Kevin, for me, I mean, this is all, Jody's is a lot more mathematical and accurate than mine. Mine's a little bit more gut and feel, but it's worked out pretty good most years. And I would say that one of the things that is helpful for me now is to rethink how some of this modeling works. And so what I mean by that is, years ago we were losing money building websites. I know that because we tracked every category of products that we did, and I could see in that one category we were losing money. So we just need to make adjustments in order to solve it. And I had to be that precise because in some areas and some services, our costs were high enough that I had to be really precise because otherwise I was going to lose money. I think that that's one thing that AI is changing is all of a sudden what's possible in a service-based business are, I believe, the margins of a software-based business. So like in a marketing agency, historically, people are trying to get 10 to 20%, a unicorn's getting 25% net margin. But in a software business, people could have 50, 60, 70, 80% margin because they don't have as many people costs. We're kind of looking at things more that way, where I go, I can charge a client, $6,000, $10,000 a month, and provide incredible value to them, but my cost is actually much lower. And so that, to me, that means I don't have to pay as close attention because I'm looking at the average over time. And as long as my total book of business and my net margin works out, I'm not that upset about it. That's not the most precise way to do it for sure, but it has worked pretty well for me in this season. And Jody, we're never going to get through this deck, obviously, at this point.
No.
But everybody that's watching, whether you're watching it live or on demand, we'll include this PDF deck in the instructions. So Jody, I don't have a hard stop, but some folks may. So if you want to kind of give us a round up the landing of the plane, however long you want. I don't have a hard stop, but we can record the rest for folks that may miss it.
Yeah. So let me wrap it up in 5 minutes if we can. So once we determine what our capacity is and our forecast, and so we created everything based on what we truly have on our team. What's our team built to do, and then we have to look and see what does our pipeline actually have that does our pipeline support that capacity, and this is where a lot of folks get it wrong, and that's where the budgets at the beginning of the year never really pan out throughout the year because you just day one your budget's going to be screwed up because life hits and you've got actuals hitting there, and so you have to look and see hey what is truly in my pipeline here. And so in this example here we've got 3 separate months. We've got we determined that we've got a $300,000 capacity in each of these months. Let's say in January, February, March. So we got 3 different months there. What do we have under contract? And I'm looking under contract. We've got 260, 210, and 150. Our pipeline's got about 50, 70, 90 in it. So we got some money in the pipeline. So we know that we can support about 310, 280, and 240. Which again, in this case, we are above capacity. We're going to do better than what we thought we're going to do for the month one. Month 2 we're under capacity by about $20,000, and then month 3 we're under capacity about $60,000. Now that's as of we're looking out 3 months, knowing that we're going to make up some of that ground every single month by these miscellaneous projects that fall in. And so in this case, we want to look and see, hey, what's our true capacity, and then we want to make adjustments over the next in our forecast based on the next 3 months of activity. And so what I mean by that is that if capacity is significantly off, I'm going to reduce or increase my forecast based on where I'm seeing. Because what I don't want to do is I don't want to make really long-term business decisions on something that's truly is not going to happen. And so we always look at about 3 months out. Very important to understand that concept there. And then the last thing is we just have to understand our numbers, our sales numbers. We have to understand the contracted capacity, our pipeline coverage. We have to understand what our close rate is, sales cycle, average deal, because all of this is going to really impact that forecast, the adjustments that we're making in there.
Tell me real quick what you mean by contract to capacity, because I'm not sure I actually even know what that means.
Okay, so what that means is that we went back and we said our capacity is $300,000. Our team is built for $300,000. What do we have under contract? We have $200,000 under contract. So contract divided capacity. So we're 67% there. So what I would do is I would look at that every single month and say, hey, if we're 67 under contract and capacity over the next 3 months, because I'm looking at a 3-month period of time, do I normally hit my numbers? Because of my process, I would know because of my processes and everything. And then next month I look at it and say, let's say I do. The next month look at it and say, hey, I'm at 67% contracted capacity. So I'm feeling pretty comfortable that I'm going to hit my numbers. The next one, same thing, 67. Now I'm at 50% 1 month. I'm like, uh-oh, I got a problem.
It's kind of a leading indicator. It's kind of a leading indicator that'll ultimately help determine net, profitability.
That's exactly right. Yep, that's exactly right. Yeah, and then the last thing is just they all work together. You've got to have your sales outlook. That fits right into that revenue forecast, which then fits into your cash flow that we talked about, and then which fits into your decisions. So the reason I brought them all in here is because a forecast, you've got to work. Everything has got to work together there. You've got to have the sales has got to sales team's got to work with the forecasting, the model, the cash model, the bank model, the decision making model. All of them are together in order for it to work out. They can't be isolated from each other. That's really about it. Again, I've got we could definitely spend another couple hours going through this whole thing in detail. But what I would do is if you have any questions or whatever, feel free to reach out. I've got a calendar link here. You can use my calendar link, hop on my calendar. I'll spend an hour with you for free, just kind of walk you through whatever questions you might have with your business to kind of work things through it. And then my phone number information, my email, all that kind of stuff's down there for your contact information. But like I said, always be happy to help. And, I'll see you obviously in person at the next Agency Builders conference, in St. Augustine.
Well, that's an awesome offer. I mean, for those of you who don't know, Jody's been doing this a long time, knows this stuff really, really good. So for him to offer just to look at things for you is a really good value. So you should take advantage of that. And Jody, it's just been such a privilege to have you. I learn something every time you share information here or at the retreats, and so really appreciate your time. Everybody else, thanks for joining us. Whether you're watching live or watching on demand, we're glad to have you. Have a good one.